and I've got a smaller crowd on today, but that's good. We'll be able to get in some good interaction to kick off this following three-part series of forward-thinking traders. Let's do a sound check real quick, as we normally do. Make sure you guys can hear my voice loud and clear, and you can see the current splash screen that says Price Action Mastery. If that's coming across well, and you can hear me all right, just give me kind of an electronic high five over the question box on your screen, and we'll make sure that the technology is working well. Great, guys. Thanks for doing that. Appreciate it. We'll record everything as usual from beginning to end, and you guys will have this shortly following the session today, so you can review all of the content with the audio, the video, all this presentation slides going forward. And find most folks like to see these a couple of times to kind of get indoctrinated with what we're teaching here. Okay, so let me do this. Let me go and get that recording started, and we'll come back to a formal introduction for recording purposes, and then we'll just jump right into the content. Okay, so just give me a minute, and I'll get that going. Hello, everybody, and welcome. I'm Toby Gennaro, and I'll be your presenter for today. The topic for today is price action mastery, and so I'm going to be talking through really the how and the why of these technical fundamentals within the context of a trading strategy. So as part two of this four-part advanced education series, we'll begin today with the technical foundation of the trade strategies. Then we'll go ahead, we'll pull that all together in parts 3 and 4, with the actual application of those trade strategies to help you understand. Now, for those of you that are on the live webinar today, if you have any questions during the session, you can type those into the question box on your screen as we move along. I'll be asking you some questions as well. We'll definitely keep this interactive. If you happen to be watching this via recording in the future and you have some questions, you'll be able to send those in as well, and I'll have some contact information for you at the end of the session so you can do that. And I just need to put up this risk warning and disclaimer quickly here. I'll leave this up for about 30 seconds. So I know you guys have seen this before last time, but we got to do this as part of the business. What this is saying in brief is that we provide education only, which means we do not give any financial advice. And as most of you know, trading the markets can be risky. It's not suitable for everyone, and you should seek independent professional advice. And if you can't accept these terms, we ask you to please cease watching the presentation and consult our website for more information. And then one more disclaimer here from Trade with Precision, if you can have a quick read through this one. And we'll be ready to dive right into the agenda here following this. Okay, everybody good? All right, then. This webinar brought to you by two organizations, Oanda and Trade with Precision. And we went over this last time, but let me just do a quick intro here. Oanda, actually co-founded by two gentlemen, Dr. Michael Stu and Dr. Richard Olson. And in the mid-1990s, Oanda quickly became the first company to offer currency exchange rate information online for free. And this was very appealing to Fortune 500 corporations with their operations around the globe, and obviously having a better need to understand their foreign currency risk exposure. So Oanda then incorporated in 1996, was again one of the first companies to offer fully automated online currency trading. The company's web-based platform known as FX Trade was launched back in 2001, and it provides both retail as well as institutional clients a state-of-the-art trading platform to work from. Current trading volumes are in excess of 1 million transactions a day, and last year Oanda was named the best trade execution provider and the best retail trading platform among a number of other awards. So just a brief history there of where Oanda has been as an organization and some of the key milestones we've accomplished there. Trade with Precision was created back in 2006 by a gentleman by the name of Nick McDonald as a provider of trading education for retail traders. So we are an international team of traders that provide training for some major brands of exchanges and brokers around the globe, and we teamed up with Oanda about 2 years ago to bring you folks some very specialized education specifically around these products, Forex products. So Trade with Precision is a company run by traders for traders, and we are specialists in trading strategy education. So we spent some time in part 1 last week just talking about mindset and price action mastery that is truly going to be critical in order to be consistent as a trader in the markets. So here's a glimpse of what's on tap for today. We want to continue this idea of building layer upon layer of technical factors to begin combining these together to produce a very high probability trading strategy for ourselves. So today you'll be learning the keys to price action mastery and how to develop your skill in reading the charts. Here in part 2, we'll wrap up the basics of the moving averages and how combining the moving averages with price action can become then a leading indicator of the next move in the markets. Now, combining price trends with moving averages creates then a very high probability trend scenario for us, right? We talked about that. So again, the fundamentals here, they're not going to be difficult for anyone to learn, but it will take some time for you to learn to put these into practice properly in live markets with real money. So we'll introduce to you the proper way of interpreting true support and true resistance levels in the price action. I think you guys will find this to be refreshingly different, and it will certainly impact your view of the markets, how you define key levels in your charts to begin to build your trade idea. So if you're currently using sloping trend lines to define your trends, you'll probably want to stop that after hearing what we have to say in this section. Sloping trend lines just have the tendency to be very subjective, and they don't provide very precise entry levels, and they don't offer us good protection for our stop loss either. Candlestick patterns, we'll show you how we identify our candles and what's important about them. You don't need to spend a lot of time remembering those 300 different candle patterns and all the corresponding names. We'll show you how to shortcut all of that and limit the list to really just a basic structure of 3 types of candles that you need to look for in your trading. They're either going to be bullish, bearish, or indecisive. It's really just that simple with candlesticks. We'll go ahead then and wrap up the basics of the moving averages and how combining the moving averages with price action can become a leading indicator of the next move in the market. Okay, so again, the fundamentals here, not going to be difficult to learn, but it will take some time to learn to put into practice for you. Okay. Now in this first section, let's just continue on from last week with the moving average patterns and zones and the things that we talked about from last week, part 1. So what are moving averages anyway, and what exactly do they do for us? Okay, so as most of you know, price action does not move in a straight line most of the time. All right, so even when the market is trending, it just has a tendency to move in these kinds of waves. So each wave offers us then opportunities to join that trend as the price action pulls back to a point of equilibrium. Okay, equilibrium being that point where price is most comfortable and there are at least as many buyers as there are sellers at that particular point in time. All right, so moving averages will identify these points of equilibrium for us, and so moving averages then become just great technical analysis tools as we look for trade setups in the market. Now, if you'll notice, each time price rallies back into the moving averages, it responds by moving again in the direction of the predominant trend, and in this case, it's downward with the momentum. So you can see these rallies back up into that sell zone in and amongst the 10-20 period moving average. And once we get that rally, we get a bearish setup candle, and then that's the setup for the next move lower. So moving averages, what they do essentially is they smooth out the short-term fluctuations in price, and they help to highlight the trend for us. Now, if we look at this chart, we can see that the 4 moving averages listed here are representative of the long-term trend. Okay, so we have the 200 period moving average, the medium term, which is the 50 period moving average, and then the short-term trends, which are the 10 and the 20 period averages. Now, at this point, I usually get the question, it's like, hey, Toby, which moving averages are best to use? Do you guys use the simple or do you use the exponential? And the answer is it really doesn't matter much at all. Either one is going to work just fine for our intents and purposes and what we're using them for. So when you go ahead and you set up your charts, just use these 4 moving averages that we have listed here. And since we teach this stuff often, we've actually standardized our color code, which is shown here: green for the 200, red for the 50, blue and black for the 20 and the 10 respectively. So as we move through these webinars, you'll know, exactly which is which simply by the color code that we have. So this right here is just an optimal chart structure that we want to see for trading. So there's nothing better than just taking this picture right here and just branding it on your brain, and that is essentially what you want to be looking for in terms of a predictable, tradable chart pattern, and that is the first thing that we're going to be looking for in these trade strategies. Okay. So another way that we use moving averages is to determine the strength of a current trend, and to do this, we look at the geometry created by the moving averages to find a common recognizable pattern in conjunction with our strong price action trend. Okay, so the moving averages, as they're set up right here, they add an additional layer of confirmation to the trend that's in question. So what we're looking for are all of these averages in alignment and rising or declining with the direction of the price action trend. And we want to see all of these averages rising or declining at a similar angle. Okay, so normally when this occurs, you'll see that the averages are going to be evenly spaced out, and the averages begin to form, this kind of a fanning out pattern that you see right here. So also when you're looking for these chart patterns, you want to identify a trending price action where the price is pulling back into the moving averages on a regular basis, okay, like you see right here, back into around that 10-20 period moving average. And that way you can scan your time frames. You're not just looking for any trend, but a trend where predictable pullbacks are occurring in a well-defined area of the moving averages. So this structure creates for us then a very high probability trade setup with the trend flow strategy that you'll be learning in the next couple sessions. So when we start to combine this moving average pattern with the price action that we understand, it then becomes just a very strong trend identifier and a good forecaster of near-term future price action. Okay, so we know exactly where to enter the trend, we know exactly where to place our stop loss, and then where to place our profit targets. Now here's the long setup related to what I just talked about. The moving averages will need to be in consecutive order with the shorter term average on top and the longer term average on the bottom, like what we just looked at. Okay, so the 10 period average needs to be above the 20 needs to be above the 50, and the 50 above the 200. Okay, so this is absolutely critical when we're identifying the correct optimal chart setup. The 200 period average is not necessarily an essential factor to the setup, just depending on the time frame that you're looking at. Okay, the setup will work with three averages that we've listed here, the 10, the 20, and the 50. If you have the 200, that's great. It just means that this is certainly a longer, more well-established trend that we're trading. So this setup with the averages signals that an uptrend is in progress. Okay, that's what we're looking for. And don't forget that we need to also compare the price action highs and lows to make sure that we have successive higher highs and higher lows. So a lot of folks tend to get confused about this one. They think that just because the moving averages look right, that they're all good to go. But if we encounter a lower low in this uptrending chart, then we do not have an optimal chart structure to trade from. Make sense? So now I mentioned that you don't need to have the 200 period average as an essential factor, but having it in the moving average geometry gives us a more established trend, which will just have a longer term momentum scenario for us. So you can use that kind of as a guide to potentially stay in the trade longer when you have all four moving averages in alignment for you on the chart. So here's a little better visual of what I'm talking about. In this first example, we have an uptrend right here, higher highs and higher lows, and that's the first identifier of a price action uptrend. And then we look at the moving averages for confirmation, right? Okay, so we have the 200 on the bottom, then the 50, then the 20, and then followed by the 10 on top. So everything's in order. In the second example, we have a good uptrend as well. Okay, with the same price action structure, higher highs, higher lows, everything looking good in terms of price, but not all of the moving averages are in order. Okay, so as you can see, the 200 period moving average is in the wrong order. But as I mentioned, the 200 average is not an essential factor for this particular optimal chart structure. The trade strategies will still work in this case, provided that you have the other three on the chart. All right, you guys tracking with me? So here's the short setup. Okay, the moving averages will need to be in consecutive order once again, with the longer term average on top and the shorter term average on the bottom. So the 10 period average needs to be below the 20 below the 50 below the 200. So again, this is absolutely critical when we're identifying the correct optimal chart setup that we want to trade. All right, so this setup with the averages signals that a downtrend is in progress. So we're also comparing the price action highs and lows to make sure that we have successive lower highs and successive lower lows. So don't get that one confused. Okay, just because the moving averages look right and they're in order and they're fanning out, you think you're good to go. Just make sure that the price action is the first thing that you look at. And if we encounter a higher low in this downtrending chart, then we do not have the optimal chart structure that we need. And so we'll just need to wait until the the charts get back into alignment again in terms of the price action. All right, so once again, when we're looking for these price action structures across multiple time frames, you want to be looking to see that the price action is pulling back into these moving averages in and around that 10-20 period moving average. Okay, you don't want price pulling back to the 50 or the 200. You want it specifically pulling back to the 10 and the 20 period. And that creates a zone for us, okay? So if the price action is pulling back too far, then you're probably too low on the time frame that you're looking at. So all you want to do is just move up a time frame or two, and you should see the proper structure. If the higher time frames are not confirming that same trend, then we do not have a good chart setup for these particular trade strategies. All right. All right, so here's that visual again of what I'm talking about. In the first example, we have a downtrend, okay, lower highs, lower lows. That's the first identifier of the price action trend that we want. And we look at the moving averages next for confirmation, right? We got the 200 on top, then the 50, then the 20, then the 10 on the bottom. Nice price action rally back into the sell zone between that 10-20 period zone with a great bearish candle setting up right here on both charts. Okay, in the next example, we have a good downtrend as well with similar price action structure. Lower highs, lower lows. Not all the moving averages are in order here on this one. But once again, you can see that the 200 period moving average, it's in the wrong order. But as I mentioned already, the 200 is, it's not an essential for an optimal chart structure for these trade strategies. The strategies will work provided that you have the other three averages in place. And as you can see, everything's rolling over very nicely. The price action looks very good. We've got those beautiful setup candles right dead in the sell zone between that 10-20 period moving average. Just waiting for a closeout of those candles, and we're looking to get short and go with the path of least resistance on this trend. So let's talk a minute about the correct usage of the moving averages so you guys understand. Okay, many traders see moving averages as types or kinds of support and resistance levels. And I just want everybody to understand that this is not our view, this is not our practice. And as we've already discussed, we use what are called horizontal levels or flat levels as our true support and true resistance levels in the price action to build our strategies around. So once again, we don't endorse trade entries if, for example, price should touch a moving average or if the moving averages should cross over. Okay, that's a common way that people tend to use moving averages, and typically when the averages are used in this way, they tend to be lagging indicators of the price action, which simply means that they're giving us their signal once price has already made its move. So remember, we need to predict price action in the markets. We can't utilize a wait and see methodology. And the way we use moving averages are just as dynamic trend lines that indicate sensible buy and sell areas on the chart, which by the way are usually the equilibrium levels that I mentioned earlier. And as we scan our charts to find those trends, we look for the time frames where price is pulling back into the moving average zone. And we do this because this is a high probability trading scenario. Okay? Now, if you guys have any questions about any of the content, this is an interactive session, so feel free just to chime in. Use the question box on your screen, fire over a question, and I'll be checking that question box on my end pretty much after every slide. And if I can respond to a question while it's still fresh in your mind, I'm more than happy to do that. So let's go ahead and talk about the moving average zones for a bit. So I'll introduce a concept here called a buy and a sell zone that's going to be a key entry indication in the trend flow trade strategy when it comes to buying or selling pullbacks within a strong trend. All right, so I pointed this out on several charts that we've looked at already. So what we're doing here is we're looking for strong trending markets and then identifying this moving average zone to provide us an approximation of where we'd like to join this existing ongoing trend. Now, keep in mind that these moving average zones, they're not exact locations on the chart, but again, they're just an approximation of where we want to begin looking for an entry signal to join that trend. Okay, so the buy zone exists around, once again, the 10 and the 20 period moving average zone while they're rising in an uptrend, and the sell zone exists around that same 10-20 period moving average zone while they are declining in a downtrend. Okay, so it's the same zone that we're looking for in uptrends and downtrends. And once you get your eyes trained to see it, it will become very obvious to you. So the one thing that you need to get good at is looking in and around this moving average zone. It may not always be that obvious, so you'll need to be flexible when you're in this zone and make sure you're looking for the right things to determine your entry across multiple time frames that you're tracking. All right, so we're looking for a very exact entry point with these trades with a very exact risk assessment in terms of our stop loss level. There's no guesswork here. The price action is going to tell us everything that we need to know. So once we get a pullback structure defined in the price action and price is in and around the buy-sell zones, that's when we begin stocking the trade for an entry. Okay, and so I'll get a little bit more specific about this entry type when we actually get to the trend flow trade strategy in parts 3 and 4 and show you exactly what that looks like, exactly where the entry is going to be, exactly where the stop loss placement is going to be, and then based on our risk assessment, we know exactly where to place our first break-even trade. Okay. So these moving average zones are going to play a major part in the trend flow trade strategy when it comes to buying or selling pullbacks within these strong trends that we're finding. So we need to understand, what this zone looks like and how price action responds within this zone when we're in a strong trending chart. And so, just so you can see, kind of what I'm talking about here, I have this zone highlighted in yellow on this chart. This isn't any kind of a proprietary indicator or anything like that. It's just a PowerPoint graphic. It has colored it in by hand just to make things very clear to you. And if we look at this uptrend example of a typical buy zone, we can see that the 10 and 20 period moving averages form a zone that price very consistently pulls back to, and then it accelerates out of. Okay, so this buy zone is that equilibrium zone that we talked about, and this is the point where price is most comfortable at that particular point in time. So there's an equal amount of buyers and sellers in the market at that point. So what we're going to be doing with these buy zones is to look for this pullback structure into the buy zone to find our trade entry within this trend. That actual entry candle is going to tell us, what price to join the trend at, and the entry candle will also tell us what our risk is on the trade or where to place our stop loss. And then based on our entry and our stop, we can then project our first profit target. Then for the downtrend example here on the right, this is an example of a sell zone. So we'd be doing the exact opposite of the uptrend example that we just talked about, looking at that 10 and 20 period moving average zone, declining to the downside with the momentum in the trend to find that same pullback structure and then join that downtrend to the short side. Okay, so you'll notice here on these trends that these rallies back up into the sell zone, okay, are created by a complete price action structure. Okay, notice it's not just one or two candles, but it's a whole series of candles, and then price gets to an equilibrium point within that zone, and then it stalls out. And normally this will present us with a rejection candle or some type of a bearish candle of some sort, and this then defines our entry and our risk parameters. So as you can see, you get these nice rejection candles in here. They're setting up right in the zone. Another one right here. Got another one right there. Another one right here, followed by another one. Okay, so sometimes you're not always going to get just one. It's not going to be a perfect setup all the time. Sometimes you get, kind of a flat consolidation in this zone, but price is just kind of consolidating there, and at some point you'll usually get a nice rejection and a break of the low of a series of candles, and that's usually our go-to signal to get short again. Munir's got a question. He's asking, what is the impact of candlestick, hammer, and a morning star in the buy-sell zone? Really, the only thing we're looking for, Munir, is the three candle patterns that we're looking at. You don't need to remember all the candle patterns that a lot of books and courses talk to you about. There are a couple hundred of them. We're just looking for three types of candles. We're looking for something bullish, something bearish, or something indecisive. So if we're in a downtrend, that very easily narrows it down to two types of candles. Either some kind of a bearish candle, an engulfing one like this, some type of an indecisive candle, a small indecisive one like that, or a nice rejection candle like this one right here. Okay, or even a nice rejection candle like that one right there. So those are really just the two types of candles that we're looking for. And the placement of the candle is really critical, and we'll continue to talk about that in detail for the next 3 sessions. Let's see, another person's asking what time frame would be the best to apply moving averages. These trade strategies are universal, which means you can apply them to any time frame from a 1-minute chart all the way up to a monthly chart. Okay, the only difference being is that it's going to take a lot longer for it to set up on a higher time frame, like a weekly or a monthly chart or a daily chart, as opposed to a 1 and a 2-minute chart. Okay, so when you're first starting to learn these strategies, take a look at some of the lower time frames, and then look across multiple time frames to get an understanding of what direction the higher time frame trend is going in. And then start to track those lower time frames, because you'll get more setups and more repeatability in any given day. And not that that's the best way to trade, but that's just a way to get your eyes trained to seeing more and more trade setups over time. The more and more you see, if you're looking at a weekly and a monthly setup, it's literally going to take weeks for a trade to set up, and you're just not going to get as much practice seeing all different types of scenarios that the market's going to throw at you. But if you start out on the lower time frames, your risk is going to be smaller, your trades are going to be shorter in time frame, and you're going to be able to see literally hundreds of setups in a month, and that's just going to help encourage your learning curve. Fair enough? Munir is asking which session is best for trading. Not sure what you mean by the best session. Are you referring to the day session or the Asian session, the European session? Okay, London time frame. Yeah, so really what you want to, okay, London, Asia, what you really want to look for, there are essentially 3 time frames you want to pay attention to. There's obviously the, the Western time frame, the U.S., and you have cash session hours for when the markets here are open and when people are, awake and getting their business day started, and people out here are trading foreign currency as well, right? But you have, London, which is effectively the, the hub of the Forex market. And so you'll see, you'll see volume pick up during U.S. cash session hours when the markets are open here, typical just business hours. And then when the Asian sessions open, which would be about 6, 7 o'clock Eastern time in the U.S., and that would put you probably around 3 o'clock in the morning London time, Munir, I think. And so that would be then the next move when another group of people, traders, are coming onto the market. They're getting up in the morning, they're getting ready for work and getting into the markets. People are expressing an opinion about what's going to happen in foreign currency that day. And then you'll have, for us in the U.S., it's going to be, midnight, 1 o'clock when, when Europe starts getting online, London, for example. And so that's kind of the, the series, and that's basically a 24-hour pattern that repeats. So you'll see in between there, when one market is closing in one country and another country's markets and business day is just beginning, you'll see some gaps in trading there where you'll have you just have low volume. The charts might be spiky. We'll take a look at a number of charts like that to show you what sessions to avoid. But you basically just want to avoid in between all of those sessions. Any one of those sessions are good for trading because people are trading the markets, literally all around the world. This is a global business. Okay, does that make sense to you? Okay, so moving along, we're talking about this this zone. Here's our optimal bullish chart structure. Strong trending price action that we've been talking about, combined with our moving average zone, all put into action right here. So this is the moving average zone that we've been talking about in action on the charts. We have a perfectly trending chart structure right here. Moving averages all in alignment, fanning out in the direction of the predominant trend. Small candles throughout this trend. We have no large candles signaling a potential end to this trend. Okay, so notice these nice pullbacks into the buy zone all throughout this trend right here in and around that 10-20 period moving average, giving us just some beautiful single setup candles. I love when you get these, even ones where you just might get 2 or 3 of them. They just look great. They're indecisive, and all of a sudden you get a nice bullish one, and then boom, once you take the break of the high of those 3 candles, you're off to the races again. Another pullback, doesn't get back as low, but we know by the small bullish or indecisive candles in this case that the market's kind of bottoming out right here within and around that zone and getting ready to take the break of the high to make another move higher again. And so just understanding that trends like this, uptrends make higher highs and higher lows. So we know that when we get this signal, the market's more than likely has a very high probability of making a higher high beyond this swing high. So it gives us a very good indication of how long we may want to be in the trade. And along with a number of other things we'll show you on how to select your profit targets and your exit points, we'll show you how that works based on the different size candles as well. Okay. So obviously when we're looking at these, we want to look at 2 time frames. This is just 1 time frame. But when we get the next time frame higher, the next time frame lower, then we want to see this similar price action structure in that buy zone once again. Okay. Munir is asking, do you have any real-time examples? Yes, we do. We'll be getting to a number of those throughout the session. These right here are actually real-time examples. This is a real-time setup right here with a pullback into the zone. So we're getting those candles setting up right there. We'll be looking at a lot of these over multiple time frames. We'll give you some that are not going to be as obvious to you. We'll give you some bad ones to look at that are going to be false pullbacks, and we'll show you how to identify some of those and when the trend is actually weakening. Fair enough? All right, let's do another one right here from the short side. We have our optimal bearish chart structure right here. We have nice, small, consistent candles. We have perfectly trending price action right here. Moving averages are in alignment. They're fanning out in the direction of the price action trend. Okay, we have no large candles signaling a potential end to this trend. Okay, so we want to pay attention to these nice pullbacks into the sell zone in and around that 10-20 period move. We've got another pullback right into the zone right here. So when price rallies back into the sell zone, you can see these small bearish candles or indecisive candles setting up in the zone. Okay, so if you recall, these small indecisive candles can work for us in both the buy zone or the sell zone, and they usually signal a reversal of the current trend, meaning that we're in a downtrend, so we're getting bullish candles rallying back up into the sell zone. If we get an indecisive candle, that usually says that price action is going to reverse back in the direction of the predominant trend, which means we're going back down again. Okay, so these indecisive candles really depend on the surrounding candles and the trend direction. So usually when you get an indecisive candle, it'll be in a downtrend, it'll be surrounded by a number of bullish candles like we see here, because it's going to be a rally back up into the zone. And then once we get the completion of that trend and a break of the low, it's surrounded by bearish candles going in the direction of the predominant trend. Okay, so like this one right here, all bullish candles moving back up, indecisive candle going back in the direction of the downtrend. So keep in mind that the setup candles in the buy-sell zones, the setup candles can be bullish, bearish, or indecisive. And so in this particular trend, we're looking for 2 types of candles, either bearish engulfing candles like this, indecisive candles like this, or there may be rejection candles like this. Okay, or very steep rejection candles like that one. Okay, but we're really only looking for 2 types of candles, bearish or indecisive, or if we're in an uptrend, we're looking for bullish or indecisive. General rule of overextension, okay, since the moving average is exactly that, it's an average of price, then the further price moves away from the average, the greater the possibility that price will snap back to the average. So we can use this overextension in any number of different scenarios. Overextension can help to define profit targets along with price action support and resistance levels for us. Overextension also helps to define our price action pullback structure when looking for the trend flow trade setup. Okay, price gets overextended from the moving averages, and then it snaps back to the moving average zone, that 10-20 period zone, and it creates an entire chart structure that begins to define our entry into that trend. All right, so an example of this would be if you were to stretch out a rubber band and then let one end go, okay, it would snap back with a lot of velocity and a lot of speed in order to get back to a point of equilibrium where the rubber band is most comfortable. Okay, so you can kind of think of price as this rubber band. When it gets overextended or stretched out, it has a tendency to snap back to its equilibrium point around those moving averages. Now, since this is the average price, this is where price is most comfortable at that particular point in time. Okay, so when you're looking through your charts this week, just look for some of that overextension in the price action, and then watch to see what happens across the different time frames. So you'll find that the higher time frames will stay overextended for longer periods of time as compared to the lower time frames. So just to get you comfortable with the average price at work in your charts, make sure you track that in the coming week. That'll help you to kind of grasp onto some of the concepts that we're going through in the next 3 weeks. Here's a good example of what this overextension looks like on the charts. So when you're looking for it, we can see an obvious gap between the current price and its moving averages, the 10-20 period zone. And usually this overextension is accompanied by 1 or 2 large candles, which, as we know from the price action analysis, large candles tend to signify the end of a trend or a short-term change in trend. And so this overextension helps to explain that principle, right? Since there is no way to get large candles without some kind of overextension from the moving averages. And as you can see in this example, once price extends away from its average, it just has the tendency to snap back with a lot of velocity and speed to the point where price is most comfortable, which is at the average. Okay, so these overextension points then become an obvious point to take some profit if we're in an uptrend, and then look for that pullback structure back into the buy zone again, looking for an entry to get long again, potentially up against this nice little prior resistance level that would now become support on the retest. And we'd have price right back in the buy zone up against a nice support level. Great opportunity to get long that trend again. Okay, so if you struggle with determining your profit targets, your exit points, then the problem is you haven't really mastered price action analysis yet. So basically, you know what you have to do, right? Just don't ignore the higher highs, higher lows, and understanding what price is doing, because you can take away all the indicators on the chart, and we still know exactly what's happening here on these pullbacks because we know what price is doing and we know what uptrends do. Okay, you guys tracking with me? Couple of chart examples for you guys to work on right here. Here's an assignment for you all to apply what you just learned, what we just talked about. 3 different charts, 3 different trends that fulfill our optimal chart trend structure requirements. And what I'd like each of you to do is to look at each chart and then determine what the next immediate move will be in terms of the price action. So what I'd like you to do is to type your answer back to me using the question box on your screen, and that will just help me to make sure that you folks are understanding what we're talking about here. So what I'd like you to do is just type, for chart A, just type an A, and then your answer up or down, and then the next one B, up or down. So go ahead, send me all 3 answers in one line if you could. Just kind of helps me to keep track of all the feedback coming in, and I can make some comments as well. So I'll just give you guys a minute to do that. I'll be quiet so you can think about what you're doing. All right, so I'm just looking through all of your responses here. I think most of you guys are getting what we're talking about here. It's usually a pretty simple concept. Now let's just walk through these charts together, and you can see how you did. Chart A, uptrend, okay, with price back in the buy zone. So we've got that pullback structure, setup candle in the buy zone. So the next move we'd be anticipating would be back up toward that swing high, and then potentially putting in a new high. Okay, chart B, downtrend with price overextended from the moving averages. Okay, so we'd be looking for at this point is a pullback or a rally back up into this sell zone. So the very next move would be up in this particular case. Chart C, okay, downtrending chart, okay, with price back in that equilibrium zone or the sell zone. So we got a rally structure. So the pullback structure already in place. We're in the sell zone. We don't have a setup candle as of yet, so we need to wait for that setup candle to close out. And basically the next move we're anticipating would be to the downside, going with the downtrend. Okay, does that exercise make sense to everybody? We covered both of the general guidelines to moving averages, overextension, and the moving average zones, or the buy and sell zones. Okay? Really critical concept there, so make sure you commit that one to memory. All right, so price action, support, and resistance, one of the keys to trading successfully, but not just any level. Okay, we're looking for true support and true resistance in order to build our trade idea around some of these levels. So when you're locating price support and resistance levels on your charts, you want to remember that this is one of the most critical components of your technical analysis that you'll be doing. So remember when we talked about this in part 1 last week, we're building our strategies around these key levels. Okay, support and resistance provides the base for a trade strategy that we're working with. And in combination with the price action trend that we've been talking about, these two technical factors together can be very, very powerful. So even with the trend flow trade, where we're looking for the bullish or bearish setup candle in the moving average zone, oftentimes that setup candle will occur at price action, support, or resistance levels. Okay, the price action is pulling back to a level of support or resistance in combination with that setup candle and with the trend and in combination with the moving average zone. And so that's what creates our high probability trade setup. So this creates for us our competitive edge in the markets. And as traders, we know we're kind of like hunters. You know, we're constantly looking for these trading opportunities or price structures where we can anticipate a predictable reaction. And so this edge is what we're using to create an increase in our success rate as traders. Okay, so remember, we only have two factors to influence: our success rate and our reward to risk. We're just stacking the odds in our favor to predetermine a profitable outcome before we start playing the game, right? So these support and resistance levels then are directly impacting our ability to do this consistently and profitably. So the idea here is, if you understand trending price action, as we've discussed, in combination with these support and resistance levels, then you effectively have the ability to base an entire trading strategy around these couple of principles here. Okay, make sense? So in talking about support and resistance, we automatically need to address the issue of sloping trend lines like you see here. Now, as I mentioned before, we use the moving averages as a dynamic trend line. That being the case, there's really no need to draw sloping trend lines on your charts, right? The 10 and 20 period moving averages are going to highlight the short-term trend very well for us. Sloping trend lines just don't offer us good support or resistance, and they're not very exact in terms of their price point. And since everyone, could possibly draw the trend line differently on their charts, sloping lines just tend to be very, very subjective. So to begin drawing static sloping lines on your charts would seem to be a bit counterproductive. Often there's a lot of importance placed on sloping trend lines, but this is typically how many folks diagram a trend line with these type of sloping lines. So the difficulty with sloping trend lines is trying to figure out exactly what you're looking for. Are you looking for price to pull back to this line, or is it that line? How do you know which one? Or if you're a seller in this downtrend, how do you define your entry point? Because on this chart, we might have several different entry points by looking at these sloping lines. So it becomes just a very subjective exercise, because naturally everyone would have a different impression of where the line should be drawn. But the moving average dynamic trend line, everybody's working with the same information. Okay, we're all looking at the exact same thing. And that's why pullbacks to the moving average zones work so well. Everybody who knows how to trade knows that this is a high probability setup. It's kind of like standard operating procedure. So once you begin watching the price action around moving averages and support and resistance levels, you'll start to see how the buyers and the sellers step in at these levels and what happens to the corresponding price action. So in order to get your eyes trained to look for true support and true resistance, here are some very good examples of what not to do. So as you'll notice on these two charts, when you see a support or a resistance level with just one touch, that's not what we're looking for. Okay, more often than not, these levels are going to be broken simply because that's what trends do, right? They make higher highs and higher lows, or vice versa. So if you'll notice on some of these single touch points, all you have to do is just wait for price action to confirm a second touch, and now you know exactly where you're at. So when these levels are broken on a breakout, any pullbacks into these levels becomes then a high probability trade setup because they're defined by multiple touches at that level, and they're very obvious to a lot of traders. So if you look carefully on some of these pullbacks, you can see where price has pulled back into a prior support or resistance level combined with the moving average zone and combined with the price action trend. And you can see then the corresponding price response. Okay? Let me take a look at the couple of questions here. Let's see if there's anything. Mike's got a question. Would two candles next to each other be one touch or two? Yeah, well, I'm going to talk about that a lot, Mike, in this section. So just stay tuned, and I'll show you exactly how that works, and you'll be able to see some good visuals here. Okay, but good question there. All right, so true resistance, as we've talked about already, true resistance is defined by looking for two or more high touches at a very specific level. So these touches should be very exact, like within a few pips. So once again, the more touches we have at that level, the better the resistance level becomes. Okay, but it's not a resistance level until it has a minimum of two touches. And so the reason we want multiple touches is because it creates for us a great place to put our stop loss. Right? Once price breaks through this resistance level, any retests of this level means that it will more than likely become support at that point. So placing our stop loss below the flat level gives us some significant protection for our stop, making our profit targets more likely to be hit than our stop loss. Make sense? So in the momentum breakout strategy that you'll be learning in this series, these flat levels at true support, true resistance will become tradable opportunities on the break of the flat level going in the direction of the predominant trend like you see here. Okay, so right here we have one touch, and then we get a nice pullback. So what we want to see, Mike, the question you asked was two candles side by side. That's not what we want to see. We want to see a nice pullback off of that, and then another rally back up into the flat level. And basically what's being done here is we're getting a pullback basically right back into the buy zone, and we're getting a nice bullish setup candle. And so what's happening is people are trading back up into potentially that level. And so you have people that are taking profit on a trade that they've been in. So you have some sellers coming into the market, and that's why we get these rejections off of this level. You get another rejection, then another move higher, a flat level consolidation, another move up to that level. We get a third touch, and then a little consolidation of small candles, and then the breakout, and then we fire off into big candles and a lot of overextension from moving averages. Okay, so that's what's happening there, and that's how that trade works out. So in order to capture this, we might be trading this, this bullish candle right here going up into the flat level, because at this point we don't know it's a flat level, so we might already be in the trade. Then all of a sudden we get into this trade, and all of a sudden price pulls back off of here. It gives you a little bit of heartburn because your stop's right here, right? But all of a sudden we see a consolidation. We've got two touches now. Price is moving higher, and then we get a third touch, and we know we're going to be back off to the races on a break. So at that point we could even add to our position on a break of the flat level. First entry is here on the trend flow. Next entry is here on the break of the flat level, and we've built a position on two different entry points, and all of a sudden we're taking our profit on the overextension of the moving averages. The large candles signifies there's going to be a pullback, and that's exactly what we're seeing here. Make sense to you? Munir is asking, should I set up a stop loss on the 50 period moving average? No. We're not utilizing the moving averages as forms of support and resistance. That's not what we're doing. We're looking for a complete price action structure. So on the breakout trade, we're going to be waiting for price to put in two touches like we do right here. Once it pulls back, it's putting in basically another higher low. So we have a higher low right here, higher low right here, another higher low here. We're moving back up for a third touch somewhere in this area. We're identifying that, you know what, price is back in the buy zone, and price is going to be moving back up, and we need to get our trade set up because we've got the two touches. We're looking for the break of that level, and so that's where we want to get taken into the trade. We want to force the market to break through that level, take us into the trade, and that's why we get this huge overextension, because a lot of other folks are trading that same trade. So you have a bunch of buy orders, buy stop orders sitting right here, and as price breaks through, it hits all those buy orders, and that's what makes it fire up like that. Okay, so we need other people involved in order to make this trade scenario work out, and that's what we're taking advantage of. So we don't want to be using the moving averages that way. The only way we're using moving averages is in the formation of the trend, confirming that trend, or we're using them as an approximate buy and sell zone. That's all. If price is pulling back to the 50 period, chances are pretty good that you're too low in the time frame. Move up a time frame, and you'll see price pulling back into that 10-20 period zone. Okay? So unlike the sloping lines that we discussed, flat levels or these horizontal lines, much more precise, provide an optimal entry point at a very exact price level. So in this example, we have several setups of true support levels within this downtrend. The touch points are very exact to within a few pips or so, like these levels right here, and the level is perfectly flat. Okay, we're looking for horizontal lines instead of sloping lines to define that trend. And the reason for that, once again, is that flat levels are very precise. So we know exactly what our entry is, what our stop is, and from that we know how to estimate our profit target from there. Now, the rule of thumb on flat levels, the more touches that you have at the flat level, the more significant that support level becomes. So since these support levels are very exacting, they become very objective, which means there's a lot less risk associated with trading around these levels because more people are trading at that level. And we need other people involved in this activity to help create the move that we're looking for. So what happens here is people have orders waiting in advance around these support levels, and as price approaches, these orders get filled, and that causes a reaction that creates multiple touches at the level. So on many of these moves down into the flat level, there's actually a trend flow trade setup in the sell zone, and just by looking at the price action, the natural reaction would be to take profit at the flat level. Okay, so that's why these levels start to set up the way they do. And once these support levels get broken, they now become resistance for any rallies back up into that zone. And you can see then what the price action does at these old support levels. They turn into resistance, and then price action fires down off of that, puts in another touch, and then breaks on the second touch. Okay? And so really we can take away all the moving averages, we can take away all the flat level lines, and we can just trade the raw price action with both the trend flow and the momentum breakout trade right here, because you would know exactly what the price action was doing. So the only thing the indicators do is they just add a number of other layers to give us more and more confidence and more confirmation that price action is predictable and it's going to do what we think it's going to do. Okay, makes sense? Munir is asking, in the breakout setup, what will be the stop loss? Stop loss is just going to be the swing high right here, right? So entry is right below the flat level. Our stop is above the swing high, and the reason for that is when we get a retest of this previous support level, it becomes resistance, and that's what protects our stop loss. So that's why we want multiple touches at that level, because it protects the stop that we have behind that, which makes our stops very difficult to be taken out, but our profit targets down here are very likely to be hit because we're going with the momentum and the flow of money out of the market in this particular case. As Katie's asking, will the moving average zone work for a ranging market? No, it won't. Katie, what you're finding is that in a ranging type market where the market is just sideways, you're not going to have successive higher highs or higher lows. You're not going to have successive lower highs or lower lows. You'll have a higher high followed by a lower low, and then back up, and you'll have this kind of zigzag price action, and you'll find the moving averages will be all bunched up. They'll be moving flat across the screen. They'll be all out of order. And typically what will happen is that's a consolidation, and at some point the market is going to break to the high side or to the low side, and usually that's going to be some form of a breakout. Okay, not always, but sometimes. So we don't want to be trading these two strategies on sideways markets. We want to trade a well-established existing trend like this with lower highs, lower lows. Does that make sense? That's really critical. If you start trading different kinds of markets with these strategies, they won't work. You'll lose money. All right. Tenjo is asking, how do you estimate the potential target after a breakdown? We'll be talking about that a little bit later throughout this session. We'll be showing you how to estimate your targets and the reason for doing that. So hang with me, and we'll get to some of that other stuff. All right, so this chart right here is showing a ranging market, like Kate just talked about, and a consolidation zone right here. So there's a good level of resistance at the top with multiple touches at that level. We have a nice support level as well with several touches down here at the bottom. So as with every consolidation zone like this, your expectation should be that price will at some point break out of this consolidation pattern, either to the upside or the downside. So these types of zones provide some very tradable opportunities off of these levels, since they're so precise and they're very exact. Now, if there is a strong prevailing trend to the downside, then you would anticipate the downtrend continuation on the break of the support level. So as you can see, the support level, it's already been broken, and it's right here, it's being retested at that same level, which should now prove to be resistance for the next move lower. Now, in order to identify that retest properly, you need to know that there has to be several closing candles at points below the support level in order for this to qualify for a retest. So ideally, you want to see a complete pullback structure in the support level before determining that it will hold as resistance. So as you can see, the breakout in the top left corner of this resistance level failed. Okay, we can't see the whole chart right here to determine the trend in this case, which would give us a very strong preference for higher or lower price action. So just by the fact that we didn't get a solid breakout of this level, and price continued to reject that level, more than likely we're in at a higher time frame. We're in a higher time frame downtrend. And this is basically just another consolidation into the moving average zone on a higher time frame. And then on a higher time frame, there's going to be some type of a rejection candle that's going to set up a couple of setup candles in the sell zone on a higher time frame that represent these three touches right here. So once you start to understand multiple time frames, we haven't covered that yet, but I'm kind of giving you some advanced stuff here on how to understand what's happening on a lower time frame like this versus how different that would look on a higher time frame. These three touches might be, two candles or one candle on a higher time frame, but it might be a rejection candle in the sell zone going with the trend to the downside. Does that make sense to you guys? Okay. TK is asking, what is a rejection candle? A rejection candle is basically one of those bearish or bullish candles. Okay, a rejection candle would be something like this right here. Something like this right here would be a rejection candle. Same as I can also call those a bearish candle. So three types of bearish candles here. One would be like a doji, another type of a doji here, and then this is an engulfing pattern, just another type of a bearish candle. So we've got three bearish candles signifying that, hey, we're at a level, three bearish candles. You should know basically off of these two candles that this market's heading lower off this level. And then, you have down here, you have rejection candles on the bullish side, right? Rejection candle like that. You have an engulfing bullish candle right here and a level that signifies that, the trend here is about to reverse back up to the high of the range, and then we have this ranging market here. So sometimes these consolidation patterns can be bottom or topping structures if they contain a lot of divergence on the indicators, the MACD and the RSI that we're using. We'll spend some time talking about that later on in the session. But since this is a momentum breakout type trade right here, you already know not to take these types of breakouts of these levels when you have a lot of divergence across the time frames, right? We already know that. Munir is asking, I have to learn pullbacks on a downtrend, then what is the use of a support breakout? If I have to learn a pullback on a downtrend, okay, so if you're trading a downtrend and you're using the trend flow strategy, then you're saying, what's the use of a support or a breakout? Well, it just gives you another opportunity to read the price action to tell you that there's a flat level setting up. You're already in a trade, and now you have even more price action to help you predict either one, another entry and build a larger position because you know the market's going to continue based on that level, or one, you can stick with the current trade that you're in and you can possibly extend your price targets based on the new information. So, I mean, continuing to read the price action even while you're in a trend and seeing additional setups. I mean, you might be in a swing trade over several days and you might be just holding the position through multiple pullbacks into the buy zone and just staying long. A lot of times, you know, a pullback into the weekly chart, it's going to run for several weeks. And you might be getting in at, you know, several different points and continuing to build a position over multiple days, multiple weeks, sometimes even a month or two. So it really depends on, you know, if you're trading intraday or you're, you know, trading across different time frames like the monthly, the weekly, and the daily, you'll be getting in some longer positions. Okay. So having more than one trade strategy, nothing wrong with that. You can even have more. We're just showing you two. You can have more than two. Some people have, you know, quite a number. Doesn't mean that the more the better. I mean, you can have 3 or 4 trade strategies. Even 2 is going to help you trade basically any strong trend. Kate's asking, how to identify a false breakout? You mentioned a few bar price closes below the resistance, only to consider a true breakout. Yeah, so all of a sudden, by the time we get out to this level, we already know that we have a ranging market, right? Price is ranging in here. We've got 3 touches here. We've got a couple of touches up here. We even have another touch here. By the time we get up here, we might have divergence on the indicators. We got a couple of rejection candles. There's going to be something in the price action telling us either on this time frame or 2 higher time frames what's really going on here. So if we're looking across 3 or 4 time frames, this is not going to be the only structure that we're looking at in terms of price. So we're going to have some pretty good clues. Not to say that we're trying to trade this range, but we might be looking for a downtrend to continue, or it's going to continue on the break of this flat level right here is what we'd be looking for. Okay? This is a good example of what happens when a true support level is broken. Okay, we have 2 or more precise touches at these various support levels, and we get 1 or more pullbacks to consistently retest the previous support level. And it consistently proves to hold, okay, the support level, and then becomes resistance in this downtrending chart. So again, this is a great reason to place our stops above these flat levels because it provides us optimal protection from loss in the downtrend. So it would just be, you know, the reverse for an uptrend. You'd place your stop below the flat level at the swing low in an uptrend. So you understand the retest principle, right? And what we're talking about, right? We get the breakout of these support levels. Price consolidates in these zones, sets up a flat level, then breaks out through the support level in the direction of the predominant trend. So this is a critical pattern for, once again, the momentum breakout trade. And as price breaks out, it then accelerates away from the moving averages with some larger candles, and that overextension then presents you with your profit opportunity for the breakout trade. Okay, you'll also notice that on the retest of these support levels, this is just going to be a typical pullback into the moving average zone with some indecisive or bearish setup candles, right? The trend flow trade. So in essence, you really have 2 different ways to trade this chart with both the trend flow as well as the momentum breakout trade. And also, since you know exactly what you're looking for in the price action, we could, you know, take away all the indicators once again and the moving averages, and you would still know exactly what to do to trade this chart pattern. Make sense? So we could not only be, you know, joining this trend on the flat level breaks, we should also be looking at these pullbacks into the zones, because we're pulling back into this zone right here with a nice pullback structure. We've got a previous support level that will now be resistance. We get a nice spike up through there, nice rejection candle setting up there, right there, that bearish candle in the sell zone. And then we're taking the break of that and we're taking it lower. And since we're coming into another level right here, we can either be taking profit at this point on some overextension of the moving averages, or we can just be holding throughout this downtrend. And then once we're already in a trade, as price sets up two flat levels, we're already in the trade. We could potentially be adding to the trade back up here on some of these indecisive candles, going short again, or adding at the break of the flat level, going short once again. Okay? So instead of averaging down on losing trades, we're actually adding to trades at a price that is worse than the price that we just bought at. So we continue to buy going, or continue to sell in this case, going with the direction of the predominant trend, which is short. Okay? And so, Kate, I don't know if I answered your question about identifying a false breakout. The false breakout is going to be with a lot of divergence. So we haven't gotten to the divergence yet on the charts, but this can also be a double bottom pattern or a reversal structure until we actually get that third touch. Sometimes you'll even get three touches, but with each touch you'll see a higher low created on the MACD and the RSI, and so the price action is flat and we have higher lows trending up. That typically means that we don't want to be taking the breakout of this level. We want to see converging indicators and converging price action. So meaning that as we're making lower lows in price, we're making lower lows on the indicators as well. And that's how we avoid trading false breakouts. Make sense? All right. Lily is asking, slide 27, the support levels didn't turn out to be the resistance levels. How do we determine whether the support levels would turn out to be the resistance levels, similar to slide 29? Okay, so if we go back to slide 27, I don't want to lose my place here. We're on 29. Okay, so 27. Yeah, everything held. I mean, these flat levels, they're not exact, but they're pretty precise. I mean, you got a level right here. This one pulls right back up in there, runs into a brick wall, and then rolls over. Here's a level right here. We got to pull back right back into that level. It falls off again. Another support level. Didn't quite even make it up to that level. It just got shorted right in the zone. So it was holding. You'll find more often than not in a good trend, when you have all your criteria together, these levels will hold if they have multiple touches. If it had just one touch, then more than likely that's not going to be a true support level. And when price retests that level, it may or may not hold. But if you have 2 or 3 touches, that's going to be a pretty solid level that when it retests, that's more than likely going to hold. Answer your question? All right, slide 30. This is a great example here of what we've been talking about. A flat level here defined by support. Okay, 2 touches at a breakout on the third touch. Price action, lower highs, lower lows, trending down into the flat level. It's always a very good identifier for a flat level break going in the direction of the trend. So we get the anticipated breakout of this support level, and as you can see, the low of the breakout is virtually almost equal to the swing high of the flat level consolidation. So that's a very good indication of a final profit target for this trade. Okay, overextension from the moving averages. If they were on this chart, meaning the moving averages, we'd have a nice bearish candle at the, a rejection candle at the bottom, and then we get the rally to retest that flat level. Okay, so this complete pullback structure then sets up our next trade, which is basically the trend flow trade, where we have a complete pullback structure off of the snapback from the overextension. Okay, and then price is right back in the sell zone. We just need a bearish setup candle in the zone, and we're trading the bounce off of that previous support level that has now become resistance. So this is a very good example of the fact that indicators on our charts are just secondary to the underlying price action. So I've just described trading this trend with 2 trade strategies and no indicator assistance whatsoever. So if you learn anything from this series, learn how to master the underlying price action. Okay, so we have nothing on this chart other than price, and we know exactly where the flat level is. We know exactly where to take the break. We know exactly where to place our stop here or here. Okay, and then we know exactly based on that information, our total risk on the trade, we know exactly where to place our profit target. Okay, and once we're out of that trade, we know exactly on the retest back up to this level, moving averages are going to be right along, trending right through here, that moving average zone, the 10 and the 20. And we have a flat level here as well. Everything converging right at this point right here gets us set up for the next trade going short. Okay, you guys tracking with me? All right, so we've covered a lot of material here on support and resistance. So time for us to potentially, well, let's actually go through these questions right here. We may take a break here. We may not. See how much time we have. Let me give you guys some homework to do right here. In order to understand this business of trading, you'll need to know what's happening in the markets and why. So knowing something in theory, never going to be enough to get really good at it, right? So remember that we talked about regarding mastery. To achieve mastery, you'll really need to know this stuff inside and out, all the stuff that we've talked about last week and this week. So let's just give you guys the opportunity to practice your craft here in kind of a supervised fashion. I would like everybody to respond to these questions via the question box on your screen. The first one here, just explain why support becomes resistance and vice versa. I mean, what is actually happening in the market? And then I'll prompt you then for the second one. Just give me your answer to the first one here. Why support becomes resistance and vice versa. Why does resistance become support? What's actually happening in the market? If you guys can give me a one-liner via the question box on your screen, help me understand that you understand why this occurs, and then we'll review that together, and then we'll go on to the next question. And I'll just be quiet here, give you guys a chance to think about that. All right, just taking a look at some of your responses here. Buyers and sellers remember that previous level. Okay, they can see it on the chart. They can see that it had multiple touches there and that it's a significant level. Let's see. On a downtrend, support shows where buyers were willing to buy to create that support level. Okay, so once they've been satisfied, the price will head lower, but will likely not pass that memorable previous price. So let's, so some folks are, let me see if I can crystallize your thinking on the reasons why these levels, these support levels become resistance and why resistance levels become support. Okay, so the first one here, why does support become resistance? Support becomes resistance, first of all, because the price action is in a strong trend. Okay, that's the very first reason. Price action is trending, making lower highs and lower lows. Second reason is because on the retest of that level, there's effectively an added bonus to the trade that includes the prior support or resistance level. So basically, we're getting a move back up to retest that previous support level, and now everybody gets the sense that they're trading against sort of a backstop, so to speak. So it's basically a move or a rally. Okay, say we're going short in a downtrend, it's a rally back up into the sell zone, And in addition to the sell zone, and in addition to, say, a bearish candle in the sell zone, you're also up against a previous support level, which now should act as resistance. So now you've just added another thing to the trend flow trade that even makes it more predictable. Okay, so that's so a lot of it has to do with memory. A lot of it has to do with just a chart setup on the charts, and the fact that other traders know how to trade, and they know that these levels, they know when they'll hold and they know when they won't, because there are either multiple touches or there's only a single touch, and that's your differentiator. Okay, so the second question here: how can this knowledge increase our probability on a trade? So I sort of just kind of gave you the answer on that one, but send me over your answers. I'll just be quiet here for a minute and let you guys respond to that one. How can this knowledge about support and resistance increase our probability on a trade? All right, so I'm just taking a look at some of your responses here. Some folks are saying it increases our probability because we have the breakout strategy set up, or we have basically a legitimate setup on the charts that not only we recognize, but everybody else recognizes as well, and that's why everything works. And that's why it's higher probability. So that's accurate. Why does it increase our probability? Let's see. Just adds another confirmation of the trade? Absolutely. Adds another confirmation of the trade. One more factor. Gives you a great stop loss level to protect your trade. Okay. Okay, so let's just go this one together. Let me give you a couple of things. Somebody's already said a few, but okay, so how can this knowledge increase our probability on a trade? Understanding this concept of support becoming resistance, or resistance becoming support on the retest. Okay, first of all, it increases the number of technical factors that we're using to determine our trade entry, right? So I gave you that one just a second ago in the previous question, and that's what the series is all about, right? It's about stacking all of the technical factors into a trade strategy to then arrive at a precise entry, a precise stop, and a precise profit target. So the only thing and our understanding of this is doing, and our knowledge of that, is it's giving us the ability to add yet another thing to our long list, our checklist of all the things that we need to engage the market in a trade. And so that's why it increases our probability on the trades, because we have more factors supporting that trade. Okay? So I think you guys get the idea that support and resistance is really an essential factor that we use in both the trade strategies that we're learning here. I've illustrated throughout the charts the significance of where these key levels come into play and how to trade around these levels with the trade strategies. This is all part of mastering the underlying price action. Now, some things I haven't mentioned, such as if there's a significant support or resistance level between our trade entry point and our profit target, then we will not take that trade. Okay, so remember, the two things that we can control in our trading is when to trade and how much we risk on the trade. And in this case, I'm talking about when to trade, right? So understanding when not to take a trade setup is just as important as knowing when to take the setup. So what this does for us is it helps us to improve our overall success rate with the strategies. So by limiting our losses and helping us to select the optimal trade setups based on our trade strategies. Okay, I've introduced reward to risk already. We always want to aim for at least a 1-to-1 reward to risk ratio. So when we're entering a trade, you want to make sure that there's a clear path from the point of entry to the first profit target. Okay, taking full profit at 1-to-1 is a perfectly legitimate strategy execution, but you'll have to realize that you're eliminating the reward to risk payout criteria from your edge in the market. So that edge being a payout that is greater than 1-to-1 and a success rate that is better than 50%. Remember, we talked about that last week. So when you're identifying support and resistance levels on your chart, it makes it easier if you look at higher time frames and also get zoomed out so you can see more historical price data on the screen. Okay, the higher the time frame charts, they're going to help out a lot in determining the more significant levels that you want to be trading around. So even if you're an intraday trader, still makes sense to check the daily chart or some higher time frames for support and resistance levels to make sure you understand where those key levels may be lurking and to also understand the overall trend direction. Okay. Let's see. Munir is asking, what is second point? What does the second point mean? The second point. If there's support or resistance between our entry point and target, are you talking about that one? Or are you going to another slide? Okay. Okay, so if there's support or resistance between our entry point and our target, then we do not take that trade. Okay, so let me, I'm actually going to go over, Munir, a couple of slides where I have that detailed on an actual chart. So I'm actually going to show you what that looks like. So if you can hang on just a minute, we'll actually get to that in just a couple of slides here. All right, so here's that example on a lower time frame chart. We're looking at a trend flow setup with a nice pullback into the buy zone and a bullish setup candle. Okay, so we have a good looking trend right here. Moving averages are in good shape. The 50, the 20, and the 10 all alignment. It looks like there's could be a good run up into this resistance level, putting in a new high. Okay, so another hint when you're considering a trade setup is to look for at least a 3-to-1 reward to risk scenario. Just give yourself enough room to run on the trade. Because remember that we want to hit as many of those second and third targets as we can, since that's what's going to drive up our earnings, that earnings profit factor, right? If we can get our profit factor up higher, then we'll be earning an average of maybe 1.5-to-1 or 2-to-1 on our trades instead of just 1-to-1, which means even at a 50-50 win-loss ratio, you're still profitable, but you could do a lot better if you learned your price action and strategies better and you actually get your success rate above and beyond 50-50. Okay, a good success target should be somewhere around 70 to 80% on your trades. That would be professional grade, and that's probably a good target that you can work toward. But for this particular trade setup right here, this one looks good. There's plenty of room to run until we hit that major resistance level, which is right at this line right here. So we got a nice pullback, a nice uptrend, good bullish setup candle. We're looking to take that right up into the new level, breaking the previous swing high, putting in a new high at that level, and we take our complete profit at that level. But all of a sudden, when we zoom out, we can actually see where the real major resistance level is. And it's only at the swing high, which really doesn't make sense to risk our capital going into a major resistance level with very little room to run. So it's still a valid trade setup, though, and probably will get to that swing high level. But we may just decide to, say, decrease our position size, maybe make some adjustments on our expectations for this particular trade, and just look for possibly maybe a 2-to-1 reward to risk payout on our final contract going into that swing high. Okay, so it's really a matter here of looking at the details of the total reward to risk calculation to see exactly what it would be. We just can't tell from this particular viewpoint. But let me just ask you guys, from what you see here, the reward to risk looks reasonable. Just in looking at this one, do you think you'd take the trade, or, what else would you want to do? I don't need you to respond to that. I just want you to kind of think through everything we've talked about and what's really going on here. So we've got that first level black. We're still kind of zoomed out. We haven't zoomed in yet. Let's go to the next screen and take a look at, at what might be happening here. Actually, I thought we had a backup there. We don't. This is actually the end of it. I believe this is the we had the black level, and then we had another level right in there, moving up into that level with another touch and several other touches in and around that level. So this is actually a smaller one. We can actually see it here, where the swing high level was going to be that previous resistance level that was going to be in and away and apart from that other level, which was the black higher level. I have two lines here, kind of the purple line and the black line very close together. But that would be an example of having resistance in the way of an additional profit target. All right, so another concept I'll introduce here that you may not be familiar with are large round numbers. That may sound odd to some of you, but let's go ahead and take a look. Support and resistance levels at large round numbers often have orders waiting there for price to reach them and trigger a potential position. So I mean orders, they're essentially the mechanisms that create the price movement that we're reading on our charts, right? So these large numbers are obviously known in advance simply because we can see them on the chart. So these levels can be leading indicators for us of potential price movement. And now what we're looking for in terms of large numbers is basically more zeros in the price level. Okay, but even getting more specific, we really need at least 2 zeros in the number to qualify for this market characteristic. Some numbers may include the ones you see here on this slide as an example. This is like anything else that we've talked about before. These round numbers, when clustered with other technical levels and factors, can become even more powerful. Okay, so we're never just looking for one thing, like a large round number. We want to build our trade idea with as many technical factors we can find in the price action. Large numbers alone do not qualify as a trade setup. So this is a good example of what I'm talking about right here on this chart. We have a solid support level that has become resistance right at the 1,000 level on the Aussie CAD pairing right here. So once again, we're combining historical price action in a cluster with a large even number to arrive at potential levels that we can begin to look for a trade setup around. So this doesn't mean that there has to be a setup here or that we're automatically trading at this level. It simply means that we're aware of the level in advance of price reaching that point. So we know what we're going to do ahead of time at these levels. We're actually stocking a trade setup, so to speak, at this point. So you can see as price reaches this level, the chart is downtrending. Actually, it's I think more like falling off a cliff here. There are no pullbacks in this downtrend, just large candles going lower, as you can see on this move right here. And as price bounces back up into this resistance level that was broken, okay, it looks like it's about a 50% retracement of this complete move right here. That would be a 50% Fibonacci retracement of the whole move, which is, guess what? It's just another technical factor that we can cluster with this level and with a big round number. Okay, so depending on what the higher time frames look like, if they were downtrending as well, then this would have been a more obvious short as price rallied back into this level. But either way, there are 4 touches at this level. So normally any moves back up to this point of resistance are going to be met with some selling pressure, simply because many traders can see it just as well as we can, and orders are just waiting there for the price action to catch up, and then you can see the reaction by price as it reverses and continues to the downside. Another example here of the Aussie-Swiss pairing. The 9,400 level has been tested and retested from both sides before finally setting up the momentum breakout and then breaking out to the downside. So these round numbers can add strength to other levels of support and resistance and price action structures, regardless of the time frame that you're looking at. But just get into the habit of looking for recognizable price action structures that you know in order to begin looking for your trade setup parameters. And once again, you can see on this chart the very predictable breakout to the downside. It's easily just as equal in size as the consolidation zone, with the high at this 103 level up here, which is another round number, and the market simply created a mirror image of this top side consolidation to this downside, to the opposing side, and along the way set up various levels of support and resistance at round numbers in and around here, like levels of 9,800 right around here, 8,800 around here, 8,300 around here, 7,800 around here. And so you just need to go back and look at the higher time frame to determine what other factors may support those levels. Okay, let's just take a look at this chart right here. We can just go through and just find all of the various levels that we can look for on this chart just by looking at the raw price action. But the level in question here is right at this this 20,000 level where price is breaking through. So when you look at a chart, you want to look for some of these significant levels on the higher time frame where you can draw a line through multiple touches that interacts with the current price action that you're looking at. Okay, so there have been a number of touches going back quite a ways here. We don't have a flat level trade setting up here because the level is not perfectly flat with these 5 touches. There's actually been closes above that level, which is what we don't want for a flat level break. It was perfect with 2 initial touches right around this level. At this point, it was perfect. But what I'd probably look at here would be maybe more of a trend flow trade with a nice bullish rejection candle in the sell zone right here, going up into that flat level and beyond, and then just breaking through the high of that setup candle right now and looking to continue higher, because we already had a couple of breaks which invalidated the flat level breakout, but all of a sudden we're positioned here with the trend flow trade. And even though we do have a significant resistance level right here, we've actually had a couple of breaks and several closes above that level, which has already violated the level. And so just a nice rejection candle gives a pretty good indication that we're pretty much going to be breaking that level again and moving higher. So there are other levels here as well. You can look at the 21,000 level right in through around here, the 22.5 level right up around here, the 20,005 level right in through here. Okay, could be argued as a historical level as well. So some good examples there of round numbers coming into play and identifying all your levels of support and resistance. Okay, so let's look at support and resistance levels here, just kind of working through some of these. Just try to look through these charts as I'm talking through them to identify, the key support and resistance levels on the chart as you begin just kind of eyeballing it and looking at the price levels on the right. See which ones you can identify with. We'll just walk through these together. The first support level we can find here is right at the 9,700 level. I've got these little red levels here identifying all the touches across that level, multiple touches through there. Next resistance level we find is at the 100 level. Nice round number again with multiple touches. Then we have the 101.50 level, which has acted as both support and resistance on a number of occasions from both sides, both directions of price. And then lastly, the 103.30 level, which has a few touches at both support and resistance. So that's how you go through a chart and then identify your levels with flat horizontal lines. So in your trading, this is what your chart should essentially look like. And it just makes it obvious to you when price is pulling back into these levels. It can tell you where bounces are likely to occur, and it can give you some trade, some setups where you can start to build trade strategies around. Okay, so let's take a look right here and talk a little bit more about round numbers acting as support and resistance. What I'd like you guys to do is just put together an answer, and you can shoot that over to me. Actually, you can just write that down on a piece of paper if you want. You don't necessarily have to send it to me. I'll give you guys just 30 seconds here to kind of think about why that is. Why might big numbers act as support and resistance? Who's placing orders here? And just think about that for a little bit. I'll be quiet, and then we'll come back and we'll talk about the answer. All right, so why might big numbers act as support and resistance? What kind of folks are placing orders here? Well, the answer here is pretty simple. Just psychologically, these are just reference points on the chart, right, that traders tend to remember. And so it just creates memory for traders, right? And additionally, they're usually coupled with historical price support and resistance. That's usually visible on the chart. So that means technical traders are typically the ones placing orders at these levels. Fundamental traders will also use some of these levels to enter their long-term buy and hold orders as well. So it's kind of a conflagration of a number of different types of traders trading differently for fundamental reasons as well as technical reasons, but all realizing the importance of trading at significant levels of support and resistance. The next question here, why is a flat support and resistance level an essential factor in the momentum breakout setup? Okay, and I'll just give you guys the answer straight away on this one. Since we're building our strategies around support and resistance levels, it makes a lot of sense because these flat levels are very precise in terms of our trade entry. So it not only gives us a very precise level to enter the trend, but it also gives us a very precise level to define our risk and our stop loss on the trade as well. Next question here in review, how might support and resistance back up a trend flow setup? So I think I already gave you the answer on this one a little while back. So I think this is on an earlier chart structure, but when the pullback structure forms and price is back in the buy-sell zone with that setup candle, many times it will be at a previous level of support or resistance. So again, it's just another technical factor for the trade where we get a rally back up into the sell zone. We get a nice bearish candle setting up. And by the way, that bearish candle sets up right up against a previous support level that is now becoming resistance. And so why is it wise to zoom out and check higher time frames before placing a trade? Because you want to see more historical price action, and the higher time frames will usually highlight any major support and resistance levels that we should be trading around. Okay. All right, so there are a couple of examples here. Let's just go through these together. Trade A, we have a nice uptrend here at a solid flat level with 3 touches. Right at this level, we have higher lows that are trending up into this level. And the way you gauge this is at the first touch of the flat level, you get the first pullback, creates the swing low, the second touch, and the next pullback creates the next higher low. And then sometimes it'll get a break on the third touch, or you'll get another pullback that'll put in another higher low. And all of a sudden you get a flat level with higher lows trending up into the flat level. That's a very obvious sign that we're going to get a breakout on this setup. Okay, we want to check the indicators at this point, which we don't have on the chart, the MACD and the RSI. We want to see that they're converging or at least flat, okay, along with the price action. Make sure they're not diverging. We want to also make sure what our risk is on the trade. Do we have a good reward to risk scenario? We've got 2 options here. We're able to stop on the more aggressive location right here. We can have a more conservative stop at the swing low. So we get set up with my stop, say below the swing low, my entry 1 or 2 pips above the high of the flat level, and set up my initial profit target at 1-to-1, and I'll dump half my position, get the trade to break even right at a mirror image of my stop loss right up here. And then the second trade setup right here, what do you think you'd want to do on this one? Okay, it's a little bit of a bumpy downtrend here. Not really. It might just be on a very low time frame. If we went up a higher time frame, you might get a better flow to the candles and to the moving averages. But nonetheless, a good momentum set up here with 3 touches along the bottom, very precise, very exact. Lower highs, 1, 2, 3 lower highs trending down into this flat level. Small candles consolidating at the flat level just ahead of the breakout with price in the sell zone means that the indicators, the moving averages are actually catching up to the price at this flat level. That's a very bullish sign, putting pressure on the flat level for a breakout. So at this point, I want to check that the indicators, again, are still converging along with price. I want to make sure we have an acceptable reward to risk setup. My stop above the swing high, entry 1 or 2 pips below the low of the flat level, and my initial profit target at 1-to-1. Basically, my entry less my stop gives me my first profit target. I just take that total risk, project it from my entry point lower, and that gives me my first top profit target. Dump half the position there, gets the trade to break even as quickly as possible. Remove all your risk on the trade, and then look for further downside with your remaining contracts. The last one here, take a look at this one. The downtrend here, just another one of those falling off a cliff ones. Not sure what happened there. It might have been a news release, but we have a consolidation at a flat level with multiple touches, and it meets our essentials list, our criteria. There's also a flat level on top, as you can see right here on both levels, both sides. Okay, I've seen a lot of folks tend to get confused on this one since they see these setups because they're just not sure what direction to go. Am I taking the break to the top side or to the downside? And the first thing we need to look at are the indicators to see if they're still converging. Okay, if they are, then we're going with the trend short. If the indicators are diverging across multiple time frames, then we definitely want to back off this trade because this might be a bottoming structure and there might be a break to the top side. Not necessarily that the whole trend's going to reverse, but there might just be a relief rally for some continued selling. Okay, so the support level on top is perfectly flat with a couple of touches there, but it's not going in the direction of the price action trend. So it does not provide us with a proper setup for the momentum breakout trade. The support and resistance level provides us an exact entry in terms of our price. Going short gives us a clear and precise calculation for our entry, for our initial profit target based on our stop and entry. Okay, so a number of things that we don't have on the chart right here that we would need, and that's just as equally important as identifying all the things that we don't have to look at, as well as identifying the things that we do have, and recognizing when we don't have those things that we need more information, and if we can't get that information, then we don't trade. All right, so let's get into candlesticks right here, help you guys understand the kind of candles that can really help us in our trading. Let me catch let's see. Munir was asking how to catch the opportunity in slide 42. In that one right there, we really didn't have enough information. Munir, we had a nice flat level on the downside, going short with the trend, but we needed to look at a couple of other factors. We needed to look at the convergence of the indicators. We needed to see at least 2 time frames to make sure that that wasn't a bottoming structure and that it wasn't diverging and that there wasn't going to be a bounce there. Okay. All right, so getting into candlesticks here, let's take a look at how we work with candles. So an interesting note here, you guys may not know this, but candlesticks originated from the Japanese markets. Candlesticks were originally devised some hundreds of years ago for the purpose of trading rice and having some organized way of looking at the price action around rice. So by looking at candles, we can get a very good indication of who's in control of the markets. And by knowing whether a candle is bullish or bearish, we're able to determine who's controlling the market at that particular point in time. And this will be our primary use of candlesticks within the trend flow trade strategy, determining if the candles in the buy-sell zone are bullish or bearish. So there are a lot of books out there and seminars that will talk a lot about candlesticks. They'll talk about the different names and the patterns, and traders just, I think, just often fall into the trap of memorizing all the names and all the candle patterns, thinking that's the key to success. So I'll make it really easy for you guys this go around, where we're going to boil this down to just 3 types of candle patterns, and that's all you need to know. Now, once again, I know a lot of books, they talk about learning all that different pattern stuff, but we find it just detracts from what's really important in trading. So there's just one thing that you know from candles, one thing you want to know, and that's who's controlling the market. Okay, is it the buyers or is it the sellers? It's just that simple. You want to know 3 types of candles: bullish, bearish, or indecisive. Okay, so the importance of candles in our trading strategies, very straightforward as well, and you'll learn that in the next part of this webinar series, that candles will help us to define both our trade entry and our total risk on the trade. But for today's session, let's just focus on understanding the candlesticks themselves and what they're actually telling us. All right, so 3 types of candlestick patterns here, and just a few things to understand about candles is that the names are not important, but the psychology behind each candle is very important. So we're just trying to figure out who's winning the tug of war in the markets here. And you also want to note that candlesticks by themselves do not form a trading strategy. So in no circumstance should you ever be taking a trade on the basis of a single candle. Okay, again, candles are just another technical factor in our strategy, right? Okay, so here we go. We have some typical bullish candles here with names like hammers and dojis. The names don't matter. It's a complete waste of time. What we need to know is whether the candle is bullish and if it gets us into a trade that makes money. Okay, a bullish candle pattern here signifies that lower prices have been tested, but they were not able to hold the lows, and those lower prices have now been rejected, and the buyers are now in control. Okay, so this right here is a nice doji rejection candle, another rejection candle here. Okay, rejection candles simply mean that you have large tails to one side or another. This right here, you have short tails on either side, so it's an engulfing pattern. It's not important that you know that. You just need to know what the candle looks like because that's what you're looking at on the chart. And this one, it's important to understand that the candle needs to be painted green to be a bullish candle. If it's painted red, then it's a bearish candle. Okay? So a bearish candle simply means that higher prices have been tested, but we're not able to hold the highs, and so those higher prices have now been rejected, and the sellers are now in control. So we'll be looking for this type of setup candle in the sell zone when we're shorting a downtrend. And any of these three bearish candles will suffice as our entry signal. So basically just the opposite of what we're looking at for the bullish candles. Indecisive candles are sometimes in the form of a doji candle. Dojis are formed when the opening and closing price of a candle are the same or they're very close to the same. Okay, so when the opening and closing price of a candle are the same or very close to the middle of the candle, it illustrates to us that neither the buyers or the sellers are winning. Okay, so indecisive candles can form at the extremes of a trend pullback, and they often signify that the direction is about ready to reverse. So if we have an uptrending chart and price is pulling back into the moving averages with bearish candles, what we're looking for here is a change from bearish to at least indecisive, if not bullish. And this type of a candle will give us that setup and signal to us that a change in direction is about to occur. So these candles may be bullish, they may be bearish, but it just depends on their surrounding candles and the direction of the overall trend. Okay, so all of these candles have typical names in one form or another. Again, not important. All you have to remember is bullish, bearish, or indecisive. Fair enough? All right, so the four key candle characteristics that we want to understand in order to read these traits properly. Candles can provide us really just a wealth of information, and they are truly a key piece of price action mastery. The color of the candles does not necessarily indicate the bullishness or the bearishness of the candle. We typically see a lot of amateur traders chasing the green candles going long, or chasing the red candles going short, but the color of the candle is really the opening and the closing price and the length of the tail versus the body of the candle. Okay, so if the candle is painted green, then that means that the closing price was higher than the opening price for that particular candle. If the candle's red, then the opposite was true, and the closing price was lower than the opening price for that candle. Okay, so the candle size is also important as well. When we're defining a trend on our charts, we want to see a series of small candles throughout the trend. This tells us that price action is predictable with very consistent buying or selling pressure throughout that trend. Next thing we want to know is the location and size of the candle's tail or the shadow. If the long tail is on the bottom of the candle, then we know that lower prices have been rejected and traders are buying the market up. If the long tail is on the top of the candle, then higher prices have been rejected, traders are selling the market off. Okay. So this type of characteristic can be a very powerful indication of the next move in price when we find these candles in the buy or sell zone. So does the size of the candle matter? Now in trading, it absolutely does matter. We want to see small candles offer us good opportunities for trade setups, and it's good to look for a small range of the candle as well as a narrow body. So why would we want small candles, and what are we trying to accomplish with this? And you can kind of think of it this way, what typically happens in the markets when a strong trend is over and about ready to reverse, usually you'll see large candles with a lot of overextension from the moving averages. And this just signifies that people are chasing the price action. There's an overabundance of confidence in the market. Maybe people are just afraid of missing the rally, and that results in either panic buying or panic selling. So you'll typically get large candles at the end of major moves, and that's typically when amateurs are trading because they're chasing the trend as opposed to waiting for the pullback and then predicting the next move in price. Okay, professionals predict moves in the market. They trade on small candles and they don't chase the price action. And so that's why the strategies we'll be talking about next week is the momentum breakout strategy. We'll be entering our trades on the small candles before they actually expand and break out into big candles. And the large candles are where we want to be taking our final profit. Okay, so candles are a crucial ingredient to our strategies. So when we're looking at the size of the candles to make an interpretation, what does small mean? And how do we determine whether a specific candle is small or not? Okay, it's a reasonable question. So this is sort of a common sense kind of thing. The term small doesn't mean we're looking at pips or tick sizes. It means small in relative terms, right? So what we're doing is comparing the candles throughout the trend to the other surrounding candles within that trend to make that determination. So this can be determined by a visual check of the charts. This will come with some experience as you log more screen time in your quest to master price action. But a few things I can tell you here. There are some trends that will have very consistent small candles, and the market will just be grinding higher or lower in this kind of a trend. Other trends will have small candles, but the pullbacks will occur on some medium or larger sized candles with overextension. So these pullbacks will put in a higher low, for example, with small candles and then continue on in the direction of the trend. And still other trends will have, many very large candles, and price will be very volatile and not as predictable. Normally you just want to stay away from this type of candle and chart pattern, or at least move to a higher time frame to get a little bit of perspective on what price might be doing. Here's a great looking trend, small candles throughout. And as I've already mentioned, you can see some larger candles throughout this trend as well. And as you can see, they always identify or signify an end to the short run up in price. So this is really that overextension principle at work. When price gets overextended from the moving averages, it has to snap back to that average. So don't get confused on the candle size issue. Just take everything in its totality. The trend, the moving averages, the small candles, the pullbacks to the buy zone, the consistently small bullish setup candles in the buy zone throughout the trend. Those are all the technical factors that make this a great trend to trade. Just want to be aware of what's happening in the price action. This is a great pictorial of those small candles in the buy zone. We want those bullish or indecisive candles because we want them small because they define our risk level on the trade, right? The smaller the risk, the better. And when we, get into the trade strategies, that will be this is going to be an essential factor for us as we take our entry into this type of a trade setup. Is there a small bullish candle in the buy zone? Because sometimes it may be a great setup, but the candle is just too big in the buy zone, and this forces you to take more risk and then project price out further in order to hit your first profit target. Okay, so entering on small candles not only keeps our risk small, but also keeps that first profit target close so we can get the trade to break even quickly. This is the short version of the same thing. Good downtrend here, nice clean small setup candles throughout the trend, offering us great reward to risk setups. Some large candles in the mix here, but you would have to examine multiple time frames to see if that was something in common across the higher time frames relative to the time frame that you're trading. Okay, the result of those large candles on this chart, just overextension and then the next pullback. So when we talk about mastering trends, there are a lot of different looks that the market will give you on a trend. So it's really your job to master the fundamentals that we're showing you here. You could end up going to the sidelines on a trend like this and then just getting frustrated by missing some of these moves. Which obviously this is it's a good tradable trend. There's no need to be afraid of volatility in the markets. We just want to make sure that it's controlled and predictable volatility. And that's why the dead giveaway here on a good trend is looking for the historical pullbacks occurring in the moving average zone. And that's the determining factor for, predictable price action. Has it occurred before is the question you want to ask yourself. We looked at a number of trend flow chart examples of those candle patterns. Now let's look at one of the momentum breakout examples and see how small candles impact this trade. We have a downtrending chart structure right here, a nice flat level setup with at least 2 touches forming that true support level that we want to see. We have a lower high trending down into this flat level, and then we get a series of small candles consolidating just ahead of the flat level. This is one of the bonus factors for the momentum breakout trade. So whenever we see this type of candle activity on the breakout setup, this is telling us that the breakout is imminent. Okay, and if you'll note here, we're entering this trade on the small candle consolidation before the candles expand out into large candles, which is then where we want to be taking our final profit, right? Okay, so entry is on the break of the flat level as the candles expand into large candles. With a sell stop order is how we do that, and our stop is above the swing high of the consolidation zone, which makes for a nice reward to risk setup. Entry right here, stop right above the swing high, and as price breaks through, it picks us up, takes us into the trade, because this is going to be an explosive move. If you try to do that manually, you'll never be able to get in, and it just comes down, boom, hits our profit targets almost instantly, and we're basically out of the trade. Another chart here, this is what we're looking for in terms of candle size. Can you see what's happening in this trend? Can you pinpoint where the professionals are trading and where the amateurs are getting in? Those small candles are setting up in the buy-sell zones, and professionals are predicting the next move in the price action. This downtrend continues to break down in the direction of the predominant trend and provides us multiple opportunities on small candle setups in the sell zone to join the momentum to the short side. So when these moves end, they end on a series of large candles, which creates the overextension from the moving average zone. And then we get that snap back to the averages once again, which provides the next setup. And we simply continue to trade this trend short until we get stopped out, basically. And at that point, the market has probably put in a higher low or a higher high at that point, and we're done. And so I see a lot of amateurs trying to trade these trends from both directions. It's just not what you want to be doing here. You'll tend to get frustrated trying to call these pullbacks, these rallies like this, and you'll just end up losing money on them. Okay. All right, so let's go through some of these trade setups right here. Let's just go through this one together. Who do you think was buying right here at this level? Okay, more than likely small candles. Professionals were doing some buying there, looking for that move higher. Who do you think was buying right here? We got large candles, a lot of overextension from the moving averages. Probably amateurs chasing the move, right? And here, who was going long? Chasing the green candles, a lot of overextension, large candles. More than likely it was the amateurs once again trying to get on board of a large move. Who's selling right here? Smallish type candles. Moving averages rolled over in the equilibrium zone. Bearish candle. Basically a head and shoulders pattern right here. Got the neckline right there. Getting a break below the neckline. Professionals more than likely are going short, recognizing that pattern. And then who do you think sold down here? Again, overextension, large candles. Amateurs love trading on those large candles, overextension away from the moving averages, just getting ready for the snapback. Okay, so the lesson here is enter your trades on small candles, smallish candles, I should say. Don't chase the price action. Don't trade on large candles because the move is most likely over. So how important is the shadow of the candle, or as some call it, the tail? Okay, what the shadow tells us is that the market has rejected the move to change direction, meaning that it has rejected price and reversed course. And as in the case of this example, price was heading lower on the bullish candle until it was rejected with buyers stepping in to drive price higher. Same with the bearish candle, price was heading higher until it was rejected with sellers stepping in to push prices lower. So it doesn't matter what the time frame chart these candles appear on. If it's a 1-minute chart, then the buyers won this bullish candle for 1 minute of trading. If it's a 60-minute chart, then the buyers won that hour of trading. A daily chart, the buyers won that day's trading. Okay. Let's quickly review our setup candles for the moving average zones, since these are pretty important to us. First, we'll look at the indecisive candle, and this one comes in a lot of different shapes and sizes and colors as well. But the idea here is a split decision type look to the candle. The open and close are very near the middle of the candle, and they can be colored either green or red or even have no color. So these candles need to be small. Sometimes you'll see large versions of these candles, and that's not what we're looking for at all. Again, we want small candles to define our risk and our entry into the markets, and you can see that candle in action here on these charts right here. Okay, this type of a candle will typically follow a string of bullish or bearish candles. Okay, in this instance, they're all bearish candles. We got red candles going down, and then we get that little indecisive setup candle right there. And then look what happens once we break the high of that indecisive setup candle. Okay, more than likely we're back in the direction of the predominant trend moving higher. Another example of the same thing, just a bearish trend. As the downtrend rallies back up into the sell zone, you typically see the candle along with some bearish candles in the sell zone to give us our setup. So the key to using these candles is to know how to enter the markets with this candle signal. In a bearish trend, okay, we'll look for this candle setup after a rally back up into the sell zone, which we see right here, and then look for a break of the low of this candle, that setup candle in the sell zone. Okay, and we want that break of the low before we get a break of the high. Okay, a break of the high prior to a break of the low of that setup candle invalidates the trade setup for us. And then you can see what happens after we get the break of that candle. We get a move back down in the direction of the overall higher time frame trend, which in this case is lower. Here are the other two classifications of bullish and bearish candle patterns that we're looking for in the buy-sell zones. The color of the first three candles is going to be important to us for both bullish and bearish. The bullish candles will need to be green. Don't ask me why they're black here, but I think we had a problem putting the green candles over the Oanda green colors, which was the background color of the box here. So I think that's why we did them black, but these would be green. So 5 different candle patterns to look out for, bullish or bearish in those buy-sell zones. Okay, so we already talked a lot about the 2 candles at the end. Okay, the long tail highlights the rejection of price in one direction and the surge of buyers or sellers coming into the market. The first 2 candles in the lineup are indisputably bullish or bearish because of the open and the closing price of the candle. Okay, they're at the complete opposite end of the spectrum. Okay, this was the open, this was the close, and people are selling off the market. Here, this was the open at the bottom, and this was the close, and people were buying the market up, and that's why it's green. Okay? And the spotlight here is on the next 2 weeks with Part 3 and Part 4 of Forward Thinking Traders. Let's see what's coming up. For next week, Part 3 will be about understanding the bigger picture view of the markets. We'll be using things like convergence between price and the indicators to assess the strength or weakness of a trend and whether that trend has the likelihood to continue in the current direction. This will be another crucial item to master since the signal will give us the confidence to continue trading the current trend until it ends. And then likewise, if we understand convergence, then we also need to understand divergence between price and the indicators. This leading indicator signal can effectively keep us out of trades and prevent us from getting into potentially losing trades. Divergence is just a great leading indicator that tells us that the current trend is weakening and may be about ready to reverse. Improving the probability of a trade outcome by combining all of our technical ingredients together along with the bigger picture view by utilizing multiple time frames. We'll show you how to look for agreement among all the technical factors across several time frames as we continue to build on a trade idea technically, and then we'll go ahead and put it all together for you in the trade strategies in Part 4. And in Part 4, we'll bring in the strategies. You'll learn the trend flow strategy, which is how to identify a strong trending chart with predictable price action that you can see right here, and then utilize a strategy to buy or sell those pullbacks within that trend and those setup candles. This is a very active strategy. We'll produce many trade setups within every strong trending market. Then there's the momentum breakout setup right here, where you'll still be looking for a strong trending chart, but the setup will be a breakout going in the direction of the predominant trend. We'll show you how to combine the technical factors to arrive at a high probability trading scenario when buying or selling these breakouts. Okay? So concluding our session for today, we'd certainly like to thank you all for joining us and hope that you guys enjoyed the presentation. We certainly welcome the opportunity to work with you guys in whatever capacity you might require. The Oanda team is available 24 hours a day, and to get in touch with us, here's some contact information for you, email and phone, or you can visit us at oanda.com for more information or to open an account with us. Once again, I'd like to thank you all for your attention. I hope you guys found the information useful. I will stay on a while longer to field any questions that you may have, if anyone has any. If you are leaving us, I'd like to thank you for attending. Certainly look forward to speaking to you again next time. But before you do sign off and leave the session, there's a short survey upon your exit. Please let us know your thoughts. We're always looking to improve on the content we're delivering to make sure that it's of value to you. So let me just take a quick look at any questions that might be coming in or anything I may have missed. You're welcome, guys. Thank you for the compliments. Glad you enjoyed the session. Appreciate it very much. Let's see. Just going through some of these other questions here. I got a lot of them here, so I'm probably missing some stuff. I apologize in advance for that. Let's see. There are a couple of new ones coming in here. Mike's got a question. Is there a way to get a copy of last week's webinar? What I got was a copy of Craig Cobb's webinar, which was very good, but I wanted to re-listen to things you were going over. Yeah, I think the way they're doing that, Mike, is they're utilizing one of the recordings to send out over the that basically that email is in an automated fashion, so they basically have one recording that they put in place in the system to send that out. So apologize for that. I don't think there's any way I can change that unless maybe you can contact customer service and maybe you can ask them if they can send you, because we do record this, and they might prompt me for the recording, and I can send that over to them and they can follow up with you. That might be one way to do it. Let's see, anything else here? TK's got a question. Why is risk reward of 1-to-1 acceptable since most traders won't get 50% strike rate? Most traders won't get a 50%. I'm not sure what you mean about a strike rate. Can you qualify that for me, what 50% strike rate means? Is that a win rate? Yeah, okay, yeah, so a 50% win rate. Yeah, so what you're saying is a risk reward of 1-to-1 simply means that you're looking to get each and every trade to break even as quickly as possible. So 1-to-1 just means that you're risking $1 on each trade to make a minimum of $1, if not $2 or $3 on the trade. That's what you're trying to do. If you're risking $1 to make 50 cents and you do that enough times, then you're going to need an incredibly high win rate in order to be profitable. Okay? If you're risking $1 to make, an average of say $1.50, you can be a horrible trader at 50% and yet you can still be profitable. Okay, if you're only doing 50% win rate with the strategies, you're making a lot of mistakes because you should be doing better than that. So two things we want to control. One, we want to have a win rate or a success rate greater than 50%, like 60, 70, or 80%. And then we also want to have a reward to risk payout greater than 1-to-1. That ensures the fact that from the get-go, when we start trading, we're set up doing the right things to be profitable. Okay, if we're constantly, getting out of the trade at, 50 cents, that's just not going to be, that's a losing proposition from day one. Okay, and we'll talk a lot about more of that in session 3 and 4. Yeah, professional traders are targeting usually about 70-80% win rate. So you're looking to be right 7-8 times out of every 10 trades. And so you're looking for this probability to play out over a larger sample set of trades is kind of the idea when you're using a strategy. It's a predetermined set of rules with risk mitigation, with all the trade entry scenarios that we've defined. And if you pay attention to all those things, it's going to keep you out of a lot of bad trades and put you in a position to be profitable over the long term. All right. Any other questions? Hope you guys are signed up for the next session. If you're not, make sure you go to the oanda.com website. Click on Forex Trading. You guys probably already know this, but if you don't, click on the Learn tab right here. Scroll down to the little projector, the movie projector. Click on Sign Up Now. You'll be presented with this page. Just scroll down. Click on Forward Thinking Traders. And scroll down and you'll have all the 4 sections. You might as well just click on this link and get signed up for all of them. And it'll give you all the times here just by clicking on this link. Get signed up for all 4, at least the next 2, 3, and 4, and you'll be all set up. Okay? And then those are all the numbers if you need to get in touch with us. Are we going to cover the RSI? Yes, we're going to cover the RSI and the MACD next week in convergence and divergence. That's very important for the momentum breakout strategy, so we'll be covering a lot of trade examples on that. You guys have basically another 4 hours to go, so if you think you're done, think again. We got a lot of content to go over. Okay. All right. So any other questions before we wrap up? We're a little bit past the hour. All right, guys. If that's the end of the questions, we'll wrap it up right here. And thanks again for all the Q&A and all the interaction. That always makes it interesting. And we'll look forward to talking to you guys again next week. And we'll go over part 3. Have a great week's trading, and make sure you spend some time on your charts, looking over the stuff that we've talked about this week, getting yourself more acquainted with price action mastery. And we'll take it to another level next week, same time, same place. We'll see you then. Take it easy.